If someone asked you right now, is your money safe inside Fidelity, Vanguard, or Schwab? What would you say? Probably something like, I think so, it must be, right? These are massive companies. Millions of people use them, it has to be safe. That answer is mostly right. But mostly right and completely right are very different things when it's your retirement on the line. In this video, we're going to answer that question completely. We'll walk through how brokerages actually work, what the law says about your money, and what really happens to your account the day one of those companies fails. Not the theory, the actual sequence of events. And at the end, I'll tell you the one thing that, quite frankly, should actually make you nervous if you're asking that specific question. And if you are asking that question, you're not alone. Millions of investors asked the exact same thing in 2023. And here's what triggered it. In 2023, 4 U.S. banks collapsed. Silicon Valley Bank, Signature Bank, First Republic, Silvergate. These were not tiny community banks. SVB alone held $175 billion in deposits. People who had money there woke up one morning and found out the thing they assumed was safe wasn't. And millions of investors looked at their brokerage accounts and had the same thought. If that can happen to a bank, what stops it from happening here? That instinct is completely natural, but it's based on a comparison that doesn't really hold. And to understand why, you need to understand one thing about how a bank actually works, because most people have never thought about it this clearly. When you deposit money into a bank, checking account, savings account, doesn't matter. That money becomes the bank's money, not yours anymore. The bank takes it, puts it on their books, and in exchange gives you a promise that says, we'll give this back whenever you ask. You go from being someone who owns money to being someone a bank owes money to. That distinction matters more than most people realize. And then the bank takes that money and bets it on something. Car loans, mortgages, government bonds, business loans. That's the entire business model. They take what you deposited and they put it to work because that's how they make money. Think of it like handing cash to a friend and saying, hold this for me. Except your friend immediately goes and invests it without telling you. If the investment pays off, great. Your friend honors the promise and hands it back whenever you ask. If it doesn't pay off, your friend doesn't have your money anymore. Someone else does. That's exactly what happened at SVB. They took billions in depositor money and bought long-term government bonds. But when the Federal Reserve raised interest rates aggressively in 2022, the value of those bonds collapsed. The money that was supposed to belong to depositors had already been turned into something worth far less. When everyone tried to pull their money out at once, there wasn't enough left. 40 years of SVB history, gone in 48 hours. FDIC insurance covers up to $250,000 per account. Below that, you're protected. Above it, you're standing in line with every other creditor in a bankruptcy proceeding, hoping to get something back. That line can take months, sometimes years. Sometimes you get cents on the dollar. That's the real risk of a bank. And it's not a flaw, it's just how banking works. The bank uses your money. That's the deal. Okay, that said, everything we just walked through, the deposits, the balance sheet, the bets, none of it applies to your brokerage account. The rules are different, the structure is different, and the answer to the question you came here with is different too. Start with one number that puts this whole thing into perspective. Schwab manages $12.15 trillion in client assets. Their entire company, every office, every employee, every piece of technology, every dollar Schwab controls as a business sits at around $500 billion on their balance sheet. A balance sheet is just a list of everything a company owns and everything it owes. And on Schwab's balance sheet, not a single dollar of that $12.15 trillion appears. And that's not an accounting error. That's the law. Your brokerage is legally prohibited from taking the money in your investment account and putting it on their balance sheet. They cannot loan it out. They cannot invest it. They can't use it to pay their own bills or cover their own losses. The moment you invest money through a brokerage, it enters a completely separate legal space from everything the company owns. Think of it like a storage facility. You rent a unit, fill it with everything valuable you own, and lock it. The facility manages the building, handles security, keeps the lights on, but they can't break into your unit and sell your belongings to pay their own rent. What's inside belongs to you. They manage the space around it. They do not own what's in it. If Schwab collapsed tomorrow and creditors showed up looking for assets, they would find $500 billion worth of company assets available to them. The $12.15 trillion in client assets or investors would be completely unreachable for the creditors, legally untouchable, because it was never Schwab's money to begin with. Now, here's the question that trips most people up, and it's exactly the right one to ask. What about the funds with the broker's name on them? SCHD is a Schwab fund. VTI is a Vanguard fund. FXAIX is a Fidelity fund. These feel like products the company built and owns. So if Schwab collapses, does SCHD go down with it? No. And here's why. Schwab doesn't actually hold the assets inside SCHD. Vanguard doesn't hold the assets inside VTI. Every ETF and every mutual fund is legally required to hire an independent third party to hold every share, every bond, every dollar inside that fund. This third party is called a custodian. Their only job is to hold those assets completely separate from the company whose name is on the front of the fund. Companies like State Street Bank and BNY Mellon do this for the biggest funds in the world. So back to the storage facility example. Schwab rents the unit and decides what goes inside, which stocks, which bonds make up SCHD. But the facility itself is run by a completely separate company that has no financial connection to Schwab whatsoever. If Schwab shuts down tomorrow, the facility keeps running. Every unit is still locked. Everything inside is still accounted for, still yours. This separation exists for a reason. The most famous example of what happens without it is Bernie Madoff. Madoff ran what looked like a legitimate investment firm, but he was acting as both the manager and the custodian of client assets, meaning he controlled the money and held the money with no independent third party checking his work. That's what made fraud possible. For every legitimate fund you own today, that situation doesn't exist. The manager and the custodian are always separate. Always. If Schwab's creditors walked into State Street Bank tomorrow and said, "We need the SCHD assets to pay what Schwab owes us," State Street's answer would be immediate. Those assets don't belong to Schwab. They never did. You have no claim to them. That belongs to the investor or clients, as they like to call it. Your money doesn't move because it was never in their hands to begin with. So the protection is real. The structure is solid. But here's what most people still haven't thought about. What does this actually look like on the ground? Not the legal framework, the real sequence of events. What happens to your account on Monday morning when the headline hits? What happens Tuesday? What happens the week after? And what's the one thing sitting at the end of all of this that nobody, not the law, not the custodian, not any government program, can do anything about? Let's get more specific and walk through it like it's actually happening. It's Monday morning. You pick up your phone and the notification is Fidelity filed for bankruptcy. The news is everywhere. Your stomach drops. So you open the app, and the first thing you need to know is not what the market is doing, but whether your account is still there. And it is. Okay. So here's exactly what happens next. A government-backed organization called SIPC steps in the same day. SIPC, the Securities Investor Protection Corporation, is essentially the emergency response team that exists specifically for this moment. Think of them like the fire department They don't prevent the fire, but the moment it happens, they're already on their way. Their one job is to make sure that every single investor, every single client's assets get found, identified, and returned to the people they belong to. SIPC appoints a trustee, and think of the trustee as the person put in charge of sorting everything out on behalf of clients. And the trustee's first job is to take inventory, every account, every position, every share. And here's where the custodian structure we talked about earlier becomes the most important thing in this entire story. Because the assets were never at Fidelity to begin with, remember, State Street or BNY Mellon already holds them, completely separate, already accounted for. The trustee is now not scrambling to find your money, they're just confirming what the custodian already knows and has always known. Within days, accounts begin transferring to another registered broker. Not weeks of uncertainty, not months of waiting. Days. Your shares of FXAIX are still your shares of FXAIX. Your positions are intact. The cost basis, meaning the record of exactly what you originally paid for every share, transfers with them. You log in one morning and your Fidelity account now lives on a different platform. Same shares, same positions, same numbers, just a different logo at the top of the screen. SIPC covers up to $500,000 in assets per customer, including a $250,000 limit on uninvested cash, meaning money sitting in your account that hasn't been put into any investment yet. Additionally, on top of that, larger firms like Fidelity and Schwab carry additional private insurance well beyond those limits. But the honest truth is, for the collapse scenario we're talking about in this video, SIPC is the cleanup crew. Not the wall that stopped the damage. The wall was always the structure, the separation, the law that said your money was never Fidelity's to begin with. So, your shares survive, your positions transfer, your account lands somewhere new within days. Ultimately, the answer to the question, is your money safe, is yes. In a brokerage collapse, genuinely, structurally, legally, yes. Your money is safe. The separation is real. The custodian is real. The law behind all of it has been in place since the 1940s, and it is held every time that it's been tested. If Fidelity or Vanguard or Schwab failed tomorrow, your shares would still be there. Your positions would transfer. Your account would quickly land somewhere new within just a few days. The brokerage's failure does not mean your money fails with it. However, remember this, the one thing nobody can protect you from is the market itself. If the kind of crisis big enough to bring down a major brokerage firm was in fact happening, something catastrophic would already be happening in the world around it. So likely the value of your investments would be moving with it. Your shares exist, what they're worth on that day is the market's answer, not the brokerage's. That's always been the trade, and that will always be the trade. But that is a market risk, not a Fidelity risk, not a Vanguard risk, not a Schwab risk. And knowing the difference clearly, completely, is worth more than any insurance policy. If you want to see what $5,000 can actually become, click the video on the screen right now. I'll show you the exact ETFs, how to split the money, and how that one investment is projected to grow into a portfolio worth over $500,000.